Hey, I'd like to welcome you to another episode of Mission Matters. My name is Adam Torres, and if you'd like to apply to be a guest in the show, just head on over to missionmatters.com and click on Be Our Guest to apply. All right, so today I have Ashley Bette on the line, and he is the founder and CEO over at Leap. Ashley, welcome to the show.
Adam, thank you for having me.
All right, so I see you were referred over to us by a friend of the show. He's been on many times. We've even published him, so Jim Wong. So a big shout out to him for booking you and introducing you to the community with us. So great to have you on. I want to get to know more about Leap, of course, today. But before we get into that, how'd you get into the business? Where'd that start for you?
Yeah, so it's a pretty long story. And so I'll just go back and just explain the origin story of how I ended up founding Leap. So having moved to the United States from Southern Africa at a young age, I lived with my aunt and uncle in the suburbs of Atlanta, Georgia. Beautiful home. They were the first owners of the home in Snellville, Georgia. Very proud to have the ability to do that. Shortly after I arrived, my uncle passed away, leaving just my aunt to kind of shoulder all of the financial responsibilities that came with the ownership of this new home. Eventually, my aunt fell sick as well, and she couldn't keep up the frantic pace of work that she'd been doing to maintain, her financial status. So she ultimately had to give up that home. And I remember, even though I was a young teenager at the time, it just didn't make sense to me that someone who had as much equity as she had in her home by diligently paying down her mortgage over the years, when she ran into a temporary hardship, I had no real solution other than looking for an exit and ultimately losing the home. Her situation wasn't the most tragic of outcomes, but it's also not uncommon. 43 million homeowners today face the exact same situation that my aunt did, where they are house rich and cash poor. And so fast forward to me having taken jobs on Wall Street and worked in fintech over the years, etc. I was introduced to this new idea of what are known as home equity agreements, which are effectively when an institution takes an ownership stake in a homeowner's home as a passive owner of a sliver of the equity in the home, enabling the homeowner to free up some of the cash that they have in that house to use for whatever they might need, to pay down debt, to pursue a financial opportunity, to send a child to college, etc. So when I learned about this new space, this relatively new asset class, a light bulb went off. I thought back to my time growing up in Atlanta, Georgia, and immediately I was drawn to the space and implemented, my finance and technology skills to, in pretty short order, get this company Leap off the ground.
So as you were creating this company, I'm curious, how did the market, in the early days, how did the market, receive this? Because it seems, when the way you lay it out, by the way, it seems pretty obvious. This is something we're solving for both your aunt and anybody else that finds themselves in that situation. How did the market receive this?
Yeah, you're right. It does seem very obvious. However, as I mentioned, the space is still relatively new, and many people, actually, most real estate professionals don't even know about the space. However, I will say in the past maybe 3 to 4 months, we've seen historic capital inflows into the space where some of the biggest private equity institutions in the country are now making significant investments into this space. So we're very excited about that.
Talk to me about the closing cycle and how that plays a factor in this whole scenario.
Yeah, so traditionally, there may be about 8 to a dozen companies that are in this space. We take pride in being the only fully digitized fintech, pure fintech in this space, and we can go from application to closing in about 4 days. That's not true for any of our other competitors.
Did you say 4 or 40? 4?
4 days. And so the reason it's 4 days, so all of our underwriting...
FOUR. No, I just want to make sure the audience caught that because that's insanely fast. Normally, before we go further into that, what's the normal sales cycle? And by the way, it's been a long time since I've been in that business, but when I first graduated college, I was in the mortgage arena. 20 years ago, right? So, but what's the normal cycle versus this? Because that's not normal.
Oh, yeah. So since you work in the mortgage space, you'll know not much has changed. We're talking about 30 to 45 days to close. And that's what
I'm saying. That's why when you said 4, I was like, 40? No, 4? Go ahead, continue. You just threw me off. That's great.
Well, yeah, I'll tell you what. So the reason it's 4 days is because by law, there's actually a 3-day cooling period. So we could actually, if it wasn't for that 3-day cooling period, giving the homeowner the opportunity to back out if they want to, we could essentially close in the same day.
Wow. Wow. I know you mentioned the fintech advantage of this. So then if it's all like online, since they're all digitized, then that means the underwriting, the like review, like all like talk about the process a little bit so people kind of have a feel of what it's like to go through that process. Maybe that'll be helpful.
Sure. Yeah, it is fully digital. People would go to our website, start the application process. It is a total of 12 fields that we ask them to complete, meaning they can actually complete the application in less than 5 minutes. Very straightforward. And the reason it's that simple is by the following. Because home equity agreements are not a loan, they're not a form of debt, we do underwrite the homeowner. Obviously, we want to know who it is that we're investing alongside. Yeah. But the main thing that we're investing in is really, and the main thing that we're underwriting is the asset. So we gather information on the asset, and in the background, we have what's known as an AVM, an automated valuation machine, that gives us a very precise idea of what the valuation of that home is. In addition to that, we have algorithms that kind of give us, take a historic look at that particular asset in terms of how it's performed with respect to home price appreciation. And based upon that, we make a prediction of how it might perform over the next 10 years or so. And so that's where the bulk of the underwriting is done, on the actual asset itself. And again, all of this is done within a matter of minutes. Within a matter of minutes, once you complete your application, you have a decision. And like I said, there's that three-day cooling off period. And so within as little as 4 days, you can actually be funded.
Yeah. Okay. So that's step one. So step one is like you can get funded, you get the money. So that's great. And I did want you to get into that because I don't want to like that 4 days. That's mind blowing. But okay. So now you have the money. Like talk about like how the payment works, like the homeowner's cash flow, right? Like ultimately they're doing this to get to for some need, possibly that's an emergency, like your aunt in that case, but maybe some other needs as well, right? Talk to me about like payback and things like that. Like how does that piece of it work?
Yeah. So like I said, most homeowners are house rich but cash poor.
Yeah, exactly.
Household debt hit an all-time high of $18 trillion in the summer of 2025. So the average person is really stuck in the debt trap. Most people take the proceeds of their home equity agreement to try to pay down some debt. And so because home equity agreements are not a loan, you can have the money for up to 10 years without having to make any monthly payments whatsoever. And when you do pay,
hence protecting cash flow, right? Like especially if they were pulling some out so that they could to cover bills or things like that. Last thing they want to be doing is now using the same money they just took out to pay back that money. Am I off on that? I just want to make sure I got it right.
Yeah, absolutely. So it helps tremendously with respect to cash flow because you now have a lump sum of cash that you can use for whatever, it was pay down debt, pursue opportunities, but you actually have cash and you're not required to make those monthly payments that we've all at some point been kind of suffocated with.
Where's the company at right now? Like, I mean, in general, like how's the response been? Like how many people, I mean, whatever you can share. I know it's private, but like the company itself, but I mean, like, well, what can you share in terms of like volume or like how many people have been helped, anything like that? Like, where's the company at now?
Yeah, so we started actually originating and funding homeowners in 2025 at a deliberate pace, trying to figure out product market fit, et cetera, with some success, quite a bit of success that we're proud of actually. In 2025, we helped a total of 185 homeowners, and that equates to about $14 million that we actually put out.
Man, congratulations, Ashley. That's absolutely amazing. That's huge. That's wonderful. Yeah, that's a lot of people. That's families. You know what I mean? Sometimes we think about numbers. I'm not saying you, but just in general, we collectively think of that. But that's 100 and something families that you help. That's amazing.
Yeah, when you look at it that way, you really get a true sense of the real impact. And you're right. Thanks for pointing that out. But, while we're very proud of the volume that we did in 2025, we view that as we were really just testing things out and proving out our tech stack, proving out our model, and establishing product market fit. 2026 is the year we're really looking forward to scale up and do multiples of the volume that we did in 2025.
Yeah, I can see that too. And I know you being a business person and the business people listening, that's the first thing we all look at, but that's why I had to hold this back for a second and say, man, that was meaningful work. You to the people that were able to get access to that capital. So that's amazing to me. I never like to glance over that. And for you to get to the product to that point, like it's not easy to start anything. So to get to get that much done in terms of volume and business, that's great. This is a great story.
You're absolutely right. Thank you.
Oh, man. Well, Ashley, this has been awesome having you on the show. We're at the end of January. We're heading into February. This is 2026, just to kind of timestamp this one. Give me the plans for the rest of the year. We're in 2026. What's on the horizon?
Sure. It's a very exciting year, the start to the year so far. We recently partnered with a publicly traded company that's providing us with a large balance sheet. I'm not at liberty to share the name of that company, but I can say that they have over $20 billion in assets under management, and we're really proud to be a partner of theirs. And with that partnership, we're really looking to scale in 2026. We're also building out some features and products that are really going to help some of our existing customers and potential customers. And I'll just touch on some of those a little bit.
Please.
We specifically target those homeowners who are underserved and who've been overlooked by traditional banks and other lenders. Typically, if that homeowner was successful in getting a HELOC or a loan somewhere, the very first question or even through us, the very first question that we ask them is, where would you like us to deposit this money? Well, we'll be unveiling a product soon that allows Leap to actually have an account or a banking as a service platform where these homeowners can actually wire that money to their Leap account. In that Leap account, they'd be able to generate or earn a yield of about 5.5% per annum. When you contrast that to your typical savings account that most banks offer, that's over 500 basis points or maybe 400 basis points over what's in the market at the moment. So that's a huge benefit to our customer base. In addition to that, we'll also be able to offer them a credit card that they can use to spend that money that comes with lower fees than existing banks do. So we're really excited about that. And again, having come from a background in a community where financial services weren't readily available to us, we try to be intentional to roll out as many products that can be as helpful to as many people in those underserved communities as possible.
Yeah, it's great. Actually, this is fun having you on, man. I can't wait I see why Jim Wong sent you to us, because you're killing it out there, and we're going to hear more and more and more about you. That being said, if somebody's listening or watching this and they want to follow up and they want to learn more about Leap, or they want to follow your journey as an entrepreneur, how do they do that?
Yeah, they can visit us at our website. It's leaphei.com. That's leaphei.com.
Fantastic. And for everybody listening, just so you know, we'll definitely put that link in the show notes, so you can just click on the links and head right on over. And speaking of the audience, if this is your first time with Mission Matters and you haven't done it yet, hit that subscribe or follow button. This is a daily show. Each and every day we're bringing you new content, new ideas, and hopefully new inspiration to help you along the way in your journey as well. So hit that subscribe or follow button. And Ashley, man, thank you for making some time for us. Thanks for coming on the show, and good luck to 2026 and beyond.
Adam, thank you so much, and same to you.